Good day, everyone. It's a pleasure to welcome you all to our very first session of Accounting and Finance for Managers. As we embark on this journey together, we'll begin by laying the groundwork for one of the most critical components of this course: accounting and the business environment. Whether you have years of experience in finance or are entirely new to the field, mastering these foundational concepts will empower you to make well-informed, strategic decisions as a manager. Accounting is often referred to as the language of business, and today we'll uncover why this metaphor holds such profound significance. By understanding this language, you'll gain the ability to interpret financial data, communicate effectively with stakeholders, and navigate the complex world of business with greater confidence. Yet 1. Introduction to Financial Accounting. Let's start with a fundamental question. What exactly is financial accounting? Financial accounting is the systematic process of recording, summarizing, and reporting the vast array of transactions that arise from a company's operations over a specific period of time. These transactions are meticulously compiled into financial statements, such as the income statement, balance sheet, and cash flow statement, that serve as a snapshot of the company's performance and financial health. Now, as future leaders in your respective fields, you're not expected to become accountants. However, you are expected to understand and interpret financial reports. Why does this matter? Because these reports are the lifeblood of decision-making. They influence everything from budgeting and resource allocation to expansion strategies, workforce investments, procurement decisions, and even potential mergers or partnerships. Picture yourself in a boardroom discussing whether to approve a major investment. Without a clear understanding of the financial data in front of you, your credibility and authority in such discussions could be significantly undermined. Moreover, financial accounting extends far beyond internal decision-making. It plays a pivotal role in fostering accountability and transparency, especially for external stakeholders like investors, creditors, regulatory bodies, and even the public. A company that fails to report its financials accurately risks more than just legal repercussions. It also jeopardizes its reputation and erodes the trust of its stakeholders. Trust, once lost, can be incredibly difficult to regain. 2. Accounting standards, the rulebook of financial reporting. Next, let's delve into accounting standards, which serve as the universal rulebook for financial reporting. Imagine you're comparing two companies, one based in Malaysia and another in Germany. Without a common framework for accounting, how could you fairly evaluate their financial performance? This is where accounting standards prove indispensable. They ensure consistency, comparability, and reliability across companies, industries, and even national borders. In Malaysia, financial reporting is guided by the Malaysian Financial Reporting Standards, MFRS, which align closely with the globally recognized International Financial Reporting Standards, IFRS. These standards dictate how businesses should record and report various transactions and events in their financial statements. They address critical questions such as: when should revenue be recognized? How should inventory be valued? What is the appropriate treatment for intangible assets like patents or trademarks? For instance, consider a company that provides software through a subscription model. According to accounting standards, it cannot recognize all the revenue from a one-year subscription up front. Instead, the revenue must be spread or deferred over the service period. This ensures that financial statements accurately reflect the company's financial position and performance, rather than presenting an inflated or misleading picture. Without such standards, the financial world would descend into chaos. Imagine airlines recognizing ticket sales revenue as soon as tickets are sold, even if the flight hasn't occurred yet. This would artificially inflate profits and distort the true financial health of the business. Accounting standards act as a safeguard, ensuring that financial reports remain fair, accurate, and resistant to manipulation. As managers, understanding these standards will help you evaluate performance metrics and ensure compliance within your organization. 3. Accounting principles. The philosophical bedrock of accounting building upon standards, we now turn to accounting principles, the core philosophies that underpin the practice of accounting. Accounting principles are essentially the general rules and guidelines that govern how companies record and report their financial data. They provide structure, discipline, and ethical grounding to the entire accounting process. Let's explore some of the most important principles. Business entity. Principle. This principle treats the business as a separate entity, distinct from its owners. As a result, personal expenses of the owner are never recorded in the company's financial statements. Going concern. Principle. Financial statements assume that the business will continue operating indefinitely unless there is evidence to suggest otherwise. This assumption influences how assets are valued and liabilities are managed. Matching principle. Expenses must be recorded in the same period as the revenues they help generate. For example, if you spend on advertising in June, but the resulting sales occur in July, the advertising expense should be matched with the July revenue. Revenue recognition principle. Revenue is recognized when it is earned, not necessarily when cash is received. This ensures that financial statements accurately reflect the timing of economic activity. Historical cost principle. Assets are recorded at their original purchase price rather than their current market value. This provides a reliable and objective basis for financial reporting. These principles create consistency, reduce subjectivity, and ensure that financial reports are both credible and comparable. For you, as managers, these principles will serve as a guide for asking critical questions, such as, are we recognizing revenue too early? Or, are our expenses being allocated correctly? Failing to adhere to these principles can lead to more than just compliance issues. It can result in flawed decision-making, reputational damage, and even financial restatements that undermine stakeholder confidence. 4. The accounting cycle, from transactions to financial reports. Finally, let's examine the accounting cycle, which represents the step-by-step workflow of recording and processing a company's financial transactions. Think of the accounting cycle as the backbone of financial reporting, a structured process that ensures every financial event is accurately captured and reflected in the company's records. The cycle typically consists of the following steps. 1. Identifying transactions. Every event with a financial impact is identified and documented. 2. Recording in the journal. Transactions are recorded chronologically using double-entry bookkeeping. 3. Posting to the ledger. Entries are transferred to individual accounts in the general ledger. Step 4. Trial balance. A summary is prepared to ensure that total debits equal total credits. 5. Adjusting entries. Adjustments are made for accruals and deferrals at the end of the reporting period. 6. Adjusted trial balance. A final check is conducted before preparing the financial statements. 7. Financial statement. Preparation. The income statement, balance sheet, and cash flow statement are generated. 8. Closing entries. Revenue and expense accounts are closed to retain earnings, marking the start of a new accounting cycle. Let's bring this to life with an example. Imagine you own a retail store. In January, you purchase R$10,000 worth of inventory on credit. In February, you sell R$7,000 worth of goods. And in March, you pay your supplier. Each of these activities flows through the accounting cycle, ensuring that your financial statements reflect not just the cash inflows and outflows, but also the timing of obligations and revenues. By following the accounting cycle, businesses can systematically track their financial activities, identify errors early, and produce timely, accurate reports. For managers like you, understanding this process is vital for overseeing cash flow, budgeting effectively, and evaluating overall business performance. Conclusion. To wrap up today's session, let's quickly recap what we've covered. 1. Financial accounting gives us the tools to record, interpret, and communicate a company's financial performance. Number 2. Accounting standards ensure consistency, comparability, and credibility in financial reporting across industries and countries. Number 3. Accounting principles provide the ethical and logical foundation for sound accounting practices. 4. The accounting cycle maps out the journey from individual transactions to comprehensive financial reports. As MBA students and future business leaders, your ability to interpret financial data will be a powerful asset, whether you're launching a startup, managing a corporate division, or serving on a board of directors. While accounting may seem technical at first, it will soon become an indispensable tool for making smarter, more strategic decisions. Thank you for your attention, and I look forward to seeing you in our next session, where we'll dive into analyzing financial statements and exploring key financial ratios to guide decision-making. Have a fantastic day.